Hi friends, this is Rajesh Ladda. I am here today to present an entire financial planning session. I have decided to break this session into total 5 different topics so that in your leisure time you can listen one by one. So every topic will be in the range of anywhere between 15 to 20 minutes. So let us start with a basic introduction. Once again, myself Rajesh Ladda. I am a founder of Retire by 49. So this particular company I founded sometime year and a half back in 2016-17 time frame. The reason being why I founded, let me give you some background so you understand what is the motto behind this organization. Most of us we spend almost 22 to 24 years building up our career by doing our graduation. Somebody has done masters, so they have spent like 24 years of study, and someone have done a bachelor's degree like BE, BTech, so they have spent 21, 22 years. So by most around 24, 25 years, we settle down into our job. And if we follow a basic principles of investment for next 25 years, so I can assure you, you can survive for minimum 50 to 60 years with the corpus what you have created with the 25 years saving. So 24 years of your graduation, 25 years of your career and some sort of an planning and savings will help you to survive for 50, 60 years. So it's like almost 100 plus years, which is more than sufficient. So that's where I decided, is it possible to retire by 49? Yes, so we can retire. And that's where we decided, let us do some kind of an awareness session so all of us can retire by 49. So let me start what I'm trying to cover. So as I mentioned, this session will be broken into minimum 5 different sessions. So we will talk about investment philosophy. So there are some basic principles which are universal standard principles we have to follow. And then we will try to see a type of investments. People see there are too many financial products and it is very difficult to understand. So we'll see how we can simplify them and invest. And then obviously risk. So there are multiple types of risk. So one is the risk which is related to investment. So whenever I invest a product, is it safe, it is secure, does it will grow or not? And the second type of risk is related to the human being. So there could be health related issue, life related risk, and various types of risk cover. So how can we cover the risk? And then obviously for investment risk there is a different methodology. For an life related risk or an health related risk, we have to take a various types of insurance so that we can mitigate. So we will see all these particular things in detail, but yes, in multiple videos. The very first, let me give you a standard disclaimer. Even though I am NISM Series 17 Retirement Advisory Certified Professional, this is from NCB and NISM initiative, still I suggest each and every person who interacts with me, try to listen to each and every person while doing financial planning and investment. But end of the day, we have to as an individually look at what our goals, what is our risk appetite, understand the product much better, and then try to invest. Listen to many, but do our own research and start investing. So this is more like an educational session for you. So listen to my session, please do a research homework and then start applying those on your personal portfolio. So let us look at a basic investment philosophy. How does an investment philosophy works? See, investment philosophy, before I go, let us look at into some basic things. Most of us we take regularly our breakfast, lunch, dinner, maybe sometimes evening snacks in between. So not more than 3 to 4 course meal every day. At the same time, we have minimum one salary if we are working in a corporate in India. If we are working in developed countries, then might be in every alternate week or bi-weekly or in weekly salaries. So our meal is also like 3 to 4 times a day. Our salary is minimum one, maximum 4 times if we work on daily wages, which we get end of the week. But when it comes to investment, what we do, it's exactly vice versa. We try to spend first, then we try to save later on, and then we decide to invest this money as per our leisure time. Sometimes whenever somebody asks, okay, now we have to submit your tax planning documents, or either we have received an handsome variable amount, then we quickly jump, or either in hurry we repay our loans with that money without understanding is it a good bad, it will help us or not. Instead of that one, what we have to do, similarly, we have to invest minimum one installment and maximum five installments every month, the way we have a regular salary and a regular diet plan. That's a simple strategy somebody follow. So please make it a note that you will be investing even if 500 rupees, that's fine, but that has to be regular. So every month, first of every month, if you are planning to invest 500 rupees, that's fine, but invest this 500 for at least 5 year, 10 year, 15-year time frame, and attach one goal to it. Then this particular investment helps. So you have a goal. Let's say, for example, you have decided a goal for an education, you require 10 lakh rupees. So you did a reverse maths. If I invest, let's say, 1,000 rupees per month, and next I will invest for 15 years, so it will be accumulating me, let's say, 7 8 lakh rupees. That's fine if it is. So that's, we have to have a goal, then start an amount, and then invest for 15 20 years and regularly review this particular portfolio. So when I say regularly, minimum once in a year. Okay, so this is what is your philosophy. So let us try to look what are the types of avenues available to invest. Again, people will believe there are so many avenues, there are so many products, and we get confused. I generally suggest there are only two types of products available in India. Okay, so there could be a subcategory obviously, but primarily there are only two categories. So what are these two categories? The first category is called as a lending money. So lending money is like nothing but people call in financial words as a debt investments. So what is lending money in India nowadays? I have 1 lakh rupee. I go to a banker and banker says, sir, the interest rate is 7.25% if you invest for 10 years. So then obviously our next question will be, what would I get after 10 years? So the banker does their own equation formula and they say, sir, it is approximately 2 lakh rupees you will get end of 10th year. So we are happy. We thought, okay, we invested 1 lakh rupee. Banker is giving around 7.25% as an interest. After 10 years, we will get back our 10 lakh. 1 lakh rupee will become 2 lakh rupee. Money is double. This particular investments are safe. Okay, but the risk is there, but the risk is very, very low. So all in this such kind of an investments are called debt investments. So in a debt investment, how to understand it as a debt? The commitment from the company, let's say for example you are buying a corporate bond, or either you are doing an FD, or either you are putting this money in a PF or a PPF. So they have given you an upfront commitment, we will give you this particular interest rate, and after this many years this is what is amount, and you invest in a lump sum. Now next come to a second type of investment. Second type of investment, the similarly whatever the money we have lent to the bank, bankers gives this money to a businessman, most of the times are the industrialist. So industrialist is nothing but they are also doing a business. So this particular money is used to buy an ownership. Let's say for example somebody has established a company, so that company has borrowed a money from the bank where we have lent the money, and they start up their business, and that kind of a particular business income should be little higher than lending money. We will see in the coming slides why it will be higher. So what will happen? A business will generate little more income than the debt income. So generally in India or across the world or a financial term, what we say the business income, or it is called as an equity. So it's kind of an equity investment. So just to give you a simple example, in India, let's say you might be tracking BSE, Sensex, NSE. So these are the various stock exchanges. The various companies are listed over there. So take a simple example, the largest company, Reliance Industry or TCS, they have listed. Their share price is being quoted and flashed every other minute on every other working day. You buy that particular share. So you become indirectly owner of that company even though you are holding one share. So this company grows, your share value grows. This company every year declares some profits. From that profit, they reinvest some into business and they declare a dividend against the share. So we get that dividend as a regular income every year, and then obviously the share value increases as the company value increases. But the risk is high here because a business will take its own time sometimes to get a proper break even. Business may have ups and downs. Business will have different kind of a scenario. If dollar appreciates, some of the company benefits, some of the companies may have the negative impacts. It crude oil prices increases, decreases, some companies will benefit, again some companies will have negative side effects. Hence we have to understand in detail. So in the upcoming slides we will see how can we mitigate the risk of this one. So I hope by this you have understood there are only two options. One is lending a money, which is a safe investment option, but the returns will be low. Second one is using this money or buying a business, part of a business, maybe even buying one equity share, we will become indirectly a partner, even though if it could be a not 1%, but still we are owner of the company. So let us see how does this overall impact. So as we so far discussed, there is a debt. Debt is nothing but lending a money. Business is we will call so far an equity. So whenever give a name as a debt, you understand this is like more of like an FD or lending money to a corporate or a banker. Whenever I say an equity, equity is nothing but investing into a business. Before we look at this one, let us try to see a broader picture. How does an inflation versus a debt versus a business income impacts in our day-to-day life? Before we go, let me give you some simple rule. It is called as a rule of 72. Okay. So what is rule of 72 and how it works? It's so simple. Okay. If I ask you to define a compound interest rate formula, it will be very complex, and then might be we have forgot because we have learned all these things in 5th and 6th standard. Instead of that one, I treat you a simple formula. Let's say for example, if somebody says education inflation will be 6%. So 72 divided by 6. It's that simple. It comes 12. So what this is indicating, after 12 years, whatever the amount today you spend on education will be double. Let's say for example, if today education, let's say even in junior KG fees is 1 lakh rupee per annum. If inflation of education or the inflation is at 6%, so 72 divided by 6 after 12 years, most likely the fees will be 2 lakh rupees. That is how. So if you go to the banker and you say, banker, I want to do an FD. So banker says we will give you 7.2% interest. 72 divided by 7.2. It comes to 10. So your money will be doubled in 10 years. If business income or any other corporate bond you have taken, and if they say, sir, we will give you 12%. 72 divided by 12, that indicates in 6 years the money will be double. That is a purpose of rule of 72, so that in future whenever you do some calculation, use this formula, it works, and you will understand what would be the target amount plus what is that you require. So by doing an inflation adjustment and the returns, you will understand, okay, my inflation is growing at 6% and my investments are growing at 7-8%. So you will understand, okay, my 1 lakh will be 2 lakh rupees. So then what should be my investment amount? With this you can do it. Okay. So let us see how inflation impacts. So let's say in 2008 in India, the engineering fees was approximately 5 lakh rupees. It was like 80,000 to 90,000 kind of annual fees, plus the hostel 40-50,000 put together. It was close to 5 lakh rupees for 4 years. In 2018, that is today, it is roughly 10 lakh rupees. It's college to college. If it is a BITS Pilani, it is 2.75. If it is something other like Vellore Institute of Technologies, it is 2.35. So the range is in the range of 9.5 and 10.5 lakh rupees. So it's a double. So what this is indicating, in a 10 years, our inflation, due to inflation, the fees has doubled. So it's a 10 year, it is getting double. So now what you do, 7.2 or 72 by divided by 10, it becomes 7.2. So what will happen, the inflation rate for education was around 7.2%. So that's what now you got inflation percentage. Now you do a reverse math, 72 divided by 7.2. So you will come to know that 10 years, every 10th year the inflation is increasing the cost of education double. So let's say same equation, we have a kid who is an 8-year-old today. With the above equation, what will happen? In 2028, the fees will likely to be in 20 lakh rupees approximately, as it indicating it is doubling every 10 years, or as I mentioned, 72 by 10, 7.2. So inflation was 7.2. With 7.2 in 10 years, it will be double. Now see, if you do an bank FD, that's where you are doing a debt investment. How versus a business income differs. So what is in a debt or an FD you are doing? You go to a banker. Banker will say, sir, yes, we will borrow your money and we will give you 7.25 percentage. So the banker has decided to give you at 7.25 percentage, and then you are happy, you came back after doing an FD. Now banker is not going to keep this money idle. Now this banker will say, let me lend this money to the purpose of any businessman or somebody else who is buying a car or a personal loan, something else. So for them, it's an average 11 to 12 percentage returns. So 7.25%, then only they can give us back. So they will be giving 7.25 back to their clients, which they have borrowed a money. Rest 4% will be utilized for obviously the employee salary, the real estate cost, the infrastructure cost, and some part will be as a profit. So the businessman also has to make some profit. So the break even is minimum 4 percentage. Hence the bankers has to lend this money at 11 to 12 percentage average, so that they can also earn money back from our FD. Now, who will borrow this money from the banker? Obviously, we decided businessman. So, businessman has to generate 11 to 12% plus 4 percentage. Same formula. If banker require 4% plus for an break even, same thing will be required for a businessman. So, the business has to generate minimum 15-16% as a profit. Otherwise, the business will not be able to repay the loans. If businessman is not able to repay the loans, obviously the banker cannot repay the money back to the lenders. Hence, the business has to do 15-16% kind of a profit to repay the business, and the business will generate profit. Hence, the business returns are generally in 15 to 16%. So that's what now we understand why a FD interest rate is low when compared to a business. If we invest into business, we should be aiming anywhere between 15-16 percentage return, versus in FD when we are doing it is 7.25 percentage. So if FD rates goes down to 5 percentage, then business has to be at least 10 percentage. So if FD rates are on the higher side, the business has to generate little more, whereas FD rates are low, automatically the business income will also be double of that one general standard formula. Then the business will have a break even. Let us try to see with a simple example how it will impact. Let's say somebody is very conservative. They say, no, I don't understand any businesses and don't want to invest into any of the business. I will invest into pure bank FD irrespective whatever it is. So the person has went back, as I told you, in 2018. Today the kid is 8-year old, and he knows that after 10 years engineering fees is going to be double from today. Hence I want to do an FD. So went to a banker said 7.25%. He applied his rule of 72. In 10 years it has to double. So the banker also said the same thing. Yes sir, your 10 lakh rupees will be approximately 20 lakh rupees. It will be 20 lakh 5,000. So 20 lakh rupees approximately. Now what was the education fees? That is 20 lakh rupees. So we thought we are satisfied. I need 20 lakh rupees. Exactly after 10 years, banker has told me he will be giving me 20 lakh rupees. So we thought we have solved our problem. Our goal one is achieved, and then we'll come back and take rest. But is that is true? That is not true. What we have missed out? There is a lifestyle upgrade. So there will be always a lifestyle also which keeps on upgrading. So let's say in 2008, if I ask any engineering student, they would be saying we were using public bus or a bicycle for an engineering college. Today 2018, if I ask, they say we use bike, we use mobile phones and other things. So obviously in 2028 things will change. So there is always a improvement in lifestyle. Hence that impacts another anywhere between 10 to 15% of cost. So we are assuming lower side of the 10%. So on a 20 lakh rupees, 10% is 2 lakhs. So this is for your lifestyle change. So now your requirement has changed. It is not 20 lakh rupees. It is 20 plus to 22 lakh rupees. The second part what we missed is tax outgo on FD. So our FD was, we done 10 lakh rupees, which is principal. So obviously on a principal no tax, but we have earned more 10 lakh rupees. On a 10 lakh rupees, obviously it is a larger amount, so we will fall under higher tax bracket. So government is 30% plus surcharge approximately 4 percentage, which translates to 31.2 percentage. So now we have to pay 3.1 lakh rupee as a tax to the government. Net amount at hand will be only 16.9. Your total requirement was 22 lakh rupees. So total deficit or a surplus. So here in this case it's a deficit which is 5 lakh rupees. So this is where the challenge, we have not understood the lifestyle challenges as well as the tax outgo. Okay, so this is the FD pros and cons obviously. So what is here only and pro? Your investment is safe, secure, you have assured returns. But cons, it was not able to beat inflation and lifestyle challenges. So how to overcome? Somebody could say easily, okay, instead of 10 lakhs, you invest 15 lakh rupees, that would have become 30 lakh rupees. tax outgo would be approximately 4.6 lakh rupees, and we would have done a good job, and we would have maybe able to secure the education purpose. We have beat the inflation, other thing. But is it possible? Already we are assuming most of us will be falling under the middle class, maybe upper or a lower middle class category, but we will fall under that one. Even a 10 lakh was a big amount. Now increasing a 10 to 15 lakh will become another challenge. What's an alternate? So alternate, let us look how business income will impact. So far what we have seen, business has to give you anywhere between 14 to 16% kind of an returns. So if we go with a mean value of 14.5 percentage, same 10 years, and we have invested 10 lakh rupees. So same rule of 72, 72 divided by 14.5, approximately 4.96. So round it to 5 years. In 5 years it will be double. So first 5 years 10 will become 20. So from 20 another 5 years it will become 40 lakh rupees. So now it's a 40 lakh rupees. Same rule, education fees is 20 lakh rupees, lifestyle upgrade is 2 lakh rupees, total requirement is 20 lakh rupees. Tax outgo on a business income from April 1st 2018 onwards, it is just flat 10 percentage. That's long-term capital gain. Even after 1 year, if you withdraw this money of investment, just you have to pay 10%. It is not like the highest bracket in FD. So what you are paying is only 3 lakh rupees. Okay, so 10 lakh rupees is principal, 30 lakhs is profit. So you will be paying only 3 lakh rupees. So net amount will be 37 lakh rupees. So what will be here total deficit surplus? Here in this case, obviously it is a surplus. The surplus will be 15 lakh rupees. Okay, so one looks safe, but we are not able to beat. Another looks risky, but we are able to beat inflation, lifestyle, and we have money lot in surplus. So what's the moral of story? FD is safe, but they cannot beat inflation and lifestyle. Business investments are risky, but they can beat. So what we could do, how to we mitigate the risk? It's a simple thing in a business. Generally, a break even, they say, is a good businesses break even are not more than 3 to 5 years. Okay, recent business, if we take a Geo itself, Geo took 5 plus years to break even. And generally, most of the good businesses have a break even within 3 and a half years kind of a time frame. But still, we want to invest for a minimum 7 to 8 plus years. So what will happen? We will be able to mitigate the business risk, because a business has 8 year cycle. So the 8 year cycle is not because of the business cycle, because of the political scenario. So just to give you a short story, in 84 Mr. Rajiv Gandhi government elected with more than two-thirds of majority, 400 plus Lok Sabha seats. Obviously they had a better power to take a decision. Hence economy was doing good, business were doing good. 84, 85, 86, 87. Towards 88 Bofar scandal opened up. He lost his government, and then Mr. VP Singh was there for 11 12 months as a prime minister, then Chandrasekhar for another 4 5 6 months. And obviously economy was not doing good, business were not doing good, stability wise concerns, political stability was not there. 1991 Mr. PV Narasimha Rao and Manmohan Singh together came as a globalization. Suddenly business started doing 91 92 93 94 95, 4 5 years outstanding. Markets were doing good, equities were doing good, business were doing good, political stability was there. Suddenly Harshad Mehta scam came in 96, markets falling like anything. Narasimha Rao lost his government. 96 97 Mr. Devagowda came back as a prime minister. Again he was there for an year or so. Then Indra Kumar Gujral another few months, and then Mr. Vajpayee came. It stayed for only 13 months. So 96 97 98 99 were worst years. Suddenly in 2000 there was a dot-com bust. In 2000 Mr. Vajpayee again got re-elected. This time they had a full majority, almost 300 plus seats with partners. Okay, so there was again stable government. So this government was doing good, lot of good policies. So 2001 it was okay year. 2002 started the business pickup. 2002 3 4 5 6 7 outstanding years. Equity markets like reached from 3000 Sensex to 21,000, 6 7 time returns in 6 years. Then suddenly 2008 US housing bust, market crashed like another 50% plus. Then 2009 Mr. Manmohan got re-elected. Again year was good under assumption that this government again will do good, all policies will come back. But for some reason 2000 mid and end, various kinds of corruption charges started coming on this government. Either it was a 2G scam, or either it was a coal scam, another thing. We will not get into political, but that has derailed a business, and equity markets were not performing. Then coming up to 2012, it was very mild year, no positive returns, rather negative returns. Market was in range bound. Then 2013, first off was fully into a range bound. Again, markets were not doing good. Towards September, Mr. Rajan elected as RBI governor. Hope started increasing. Rajan is one of the famous economists and thought he will bring some radical changes and which will help, and it started helping. And by the time Modi wave started in India, thought Modi will come and then things will change. And 2014 was an outstanding year. 15 was again back normal year. They have lost couple of elections in Bihar and Delhi. Then 16, 17, everybody knows equity markets were doing phenomenal, and 18, no predictions, but looks like it's going to be again a subdued year. 19, again after an elections, things may pick up, and this equity market can run up to 2022 in a good phase. So why I'm trying to give you this entire 30, 35 years of an history is 84 to 91 you saw 4, 5 good years, 4, 5 okay years. 91, 92 to 2000 again 4 good years, 4 okay years. 2001 to 2008, 5, 6 good years, 2 bad years. 2009 to 2016, 17, 3, 4 good years, 3, 4 normal years. Hence, that's what I mean to say. If you go for an 8 years kind of investment, you can beat this risk. So, how to beat a business income risk? If you are there for 1, 2, 3 years, you will always have a risk. You may be in the beginning of the cycle or end of the cycle of a business, then the problem will start. Hence, if you are there for that full 8 years, I can assure you, you will be able to have a positive returns after 8 years for sure. Okay. Now, in EBO case, what happened? One is giving you, I will not say negative return, but it is not surplus, it is a deficit. So you are falling short by doing FD. Another one giving you surplus by almost 50-60% more. Instead of that one, let us take a plain vanilla case, a 50% if we have invested in both. So we have distributed a risk properly. As saying goes, don't invest everything into don't put all your eggs in a single basket. Same way, don't invest everything into a single business or in a single bank as an FD. That could be a risky. Hence we had 50% in FD kind of a thing, 50% into business. Even at a 50%, 50%, bank FD would have given 8.5 lakh, business would have given 20 lakh rupees with a tax outgo. We would have approximately 27 lakhs at hand. So still we have able to generate more than 22 lakhs, that is 25% more than the required amount. This is also able to help us beat the inflation and obviously the lifestyle changes. This does not mean I am saying you invest 50%, 50%. I'll give you simple rules. So follow these rules for investments. So let us see what are our investment rules. The very first, the formula is simple. If your age is 30, 100 minus 30, okay, then it is 70. So 70% of your savings should go into equity kind of an investment, that is into a business. Rest 30% to invest into debt, that is various kind of safe investments. This is first rule. If your age is 35, obviously it will become 65, 35. Now let us assume you have a money flow of 100 rupees. How should I distribute this 100 rupees? This 100 rupees we should distribute 40% of that amount in EMI. So nowadays we have various EMIs like car loan EMI, housing loan EMI, or any other personal loan EMIs. Not more than 40% of all any combination should go other than EMI part, 40%. If it is greater than 40% means you have borrowed money more than you can serve. Rest 30% should be your savings portfolio. That is very critical. Only for savings, 30% mandatory saving, rest 30% are for your day-to-day expenses. Okay, so people most of the times agree this 30% day-to-day expenses, 30% savings, we agree, but 40% of money for EMI is not sufficient. If we live in a tier 2 city, the minimum is 50-60 lakh kind of an home. Even basic 2 BHK is 60 lakh rupees. If we do a down payment of 10 lakh rupees, 50 lakhs we have to borrow, and EMI will be anywhere between 47,000 rupees, and our salaries are not more than 70-80,000 per month. So how should we do adjust with this 40? We will shortfall by minimum 10-12,000 rupees. So there are two simple solutions. The very first, if your salary is in range of 70-80,000, so obviously you will be in your mid 20s towards late 20s. Go and tell banker, I need a loan for minimum 30 years. So the loans are given up to age of 60. So even if you are a 30-year-old, you take a loan for 30 years. So this will decrease your EMI amount and that will fit into your 40 percentage. After 3-4 years, if your salary increases, go and increase a bit of your EMI percentage if required. Otherwise, the 40 percentage matches. Okay, this is first rule. Second rule. Second rule is also simple. Right now, if it is not fitting into your 40% formula because of the EMI amount, try to postpone this purchase to 3-4 years, whatever it is shortfall. If shortfall is, let's say, 20 percentage, so 2 years later your salary on a year on year, if we see a growth basic of 8%, you will have a 20% growth on your salary. So from that 20 percentage you should be able to buy it. So postpone by 2 to 4 years, whatever the shortfall. If the shortfall is close to 30-40 percentage, they wait for 3 to 4 years. If it is 15-20%, wait for a year or two, or either increase the tenure from 15-20 years to 25-30 years. Okay, so that is how we should be able to handle it and then do a purchases. But the rule is simple. Your 100 rupee outflow has to be 40 rupees for EMI, 30 for saving, and 30 for your day-to-day expenses. Now let us assume this 30%, as I mentioned, if somebody's salary was 48,000, the EMI should have been 19,200, saving should be 14,400. So now 14,400, as I mentioned, age is 30. If age is 30, then what will happen? 30 should go into debt and 70 should go equity. So approximately 10,000 should go into equity and 4,500 or 4,400 should go into debt. This is my personal case study. So just I'll tell you, when I was exactly 30 years old, that is 12-13 years back, this was my salary and I applied this formula and it works my magic. And let me tell you why. You cannot believe, at age of 43 today I'm talking to you. I am retired happily. I'm sitting at home. That's what I tell. If we follow these basic principles, we should be able to happily retire by 49. But here in my case, as I told you, I have been retired at age of 43, just following this simple principle. Exactly 13 years, 12 and a half years back, I was 30-year-old. My salary was 48,000. My EMI was 19,129. You will not believe. I used this particular formula. I used to save close to 15,000 rupees and my spending was around roughly 14,000, 13-14,000. And this has worked like a magic and that's helped me to retire at age of 43. So these are the rules you follow. With this, I end my part 1. We'll meet you in a part 2 with the types of investments. Thanks a lot for listening me out. I will see you back on a series 2. Thank you once again. Have a great day.